Welcome to this video on managing interest rate risk with ETFs. Please remember that nothing in this video should be interpreted as financial advice. You should always do your own research when it comes to investing. Let's start with what we mean by interest rate risk. If you buy a bond fund, the bonds within it will gain in value if interest rates fall and fall in value if interest rates rise. There's an inverse relationship between price and yield. The reason for that is that bonds lock in a fixed rate of interest, which becomes less attractive if interest rates rise. The longer you lock in a fixed rate of interest, the more sensitive a bond will be to interest rate movements. So you can see the bond in the top panel is locking in a fixed rate of interest, 5% for 5 years, whereas the bond at the bottom is locking in the same rate, but for 10 years. Consequently, the bond at the bottom will be more sensitive to interest rates than the bond at the top. And the reason for that is that you've locked in a fixed rate of interest for twice as long. In other words, the bond at the bottom has about twice the duration of the bond at the top. So this is why the scaling factor, which is used to measure interest rate risk, is called duration. And this concept of duration applies not just to single bonds, but also to bond funds. The result of all this is that as interest rates move up and down, the price of your bond funds, your single bonds as well, will also fluctuate. Greater duration means larger fluctuations in the price of your bond. So here you can see two UK government bond funds to illustrate that. Note that the shorter duration bond fund, which is shown in red, has smaller price fluctuations than the longer duration bond fund, which is shown in blue. The most important interest rate risk measure for a bond fund is its duration. But you may be wondering, how can you find this? Well, in the case of the two bond funds that we saw previously, you can find their duration on their fund manager's website, and their fund manager is State Street. Sometimes you'll find it in the bond's fact sheet. And of course, Morningstar, the website, is also very useful for finding these bond fund durations. Given the importance of duration, what does this mean if we think rates will fall or rise in future? If we think interest rates are going to fall, then the price of our bond funds will increase. Ideally, we'd like that increase to be as large as possible, so therefore we'd go for a bond fund which has a long duration. Conversely, if we think interest rates are going to rise, then we'd shorten the duration of our bond investments by choosing shorter duration bond funds. And if we think interest rates are going to rise a lot, then ultra-short bond funds are also available, which have very little duration and which will lose very little value if interest rates do rise. Interest rates have an added dimension compared to stocks, which is the term of lending, and it's helpful to understand the yield curve. Here you can see the cost of borrowing for the US government over a 1-year period and a 10-year period, but also how those rates have changed all the way back to 1962. You'll notice that the rates are quite different. While short-term rates are strongly driven by what the central bank does and its policy rate, longer-term rates are also driven by things like GDP growth expectations, but also inflation expectations. Sometimes these get out of sync, so the curve could steepen or flatten. Usually what we see is that short-term interest rates are lower than long-term interest rates, as you can see in this graph in the bottom panel where the graph is shaded in blue. But when this reverses and the yield curve inverts, which is shown in red, a US recession has often followed shortly afterwards. US recessions are indicated by the shaded regions on this graph. If short-term rates fall relative to long-term rates, then the curve steepens. Now, it is possible to buy exchange-traded funds which benefit if the yield curve does steepen. So instead of profiting from yields rising or falling generally, these funds will benefit from the 10-year US yield rising relative to the 2-year yield, for example. Examples of such ETFs include the Amundi US Curve Steepening 2 to 10 year. This is available with ticker STPH, and that version is sterling currency hedged, or STPU, which is unhedged. And so the unhedged version of a fund will gain or lose in value as the dollar strengthens or weakens versus sterling. I hope this video has helped you gain a greater understanding of how to manage interest rate risk in your portfolio. If you did find it helpful, then please do like the video and also subscribe to Trading 212's channel so you don't miss out on any future videos.